Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the Econ Show, we're going to have two shows mashed together, but we're going to go a little bit quicker through them to make sure we cover everything that we want to. And in segment one, we're going to look at obviously what's happening in Russia, what's happening in some of their different flows with their neighbors. But we also want to look at credit, how is credit flowing, and then obviously food being such a huge component. In the second segment, we're going to look at U.S. GDP and how things have shifted with now that we have the inflation number, we have producer price indexes, we have some leading indicators. We want to see how is that impacting the consumer. Then in the third segment, we're going to look at some of the leading indicators for the U.S. What does that mean? How are things going to progress as we go through the remainder of Q2 and really as we turn into Q3? And are we going to have that recession? Because remember, Q1 was negative. Europe, we're going to cover where some of the pain points are, how that's going to progress, especially as we go into the summer months. And then in the last segment, we're going to look at really India and China. We want to talk about India a decent amount, given the fact that we had their inflation data. What does that mean for them geopolitically on a fundamental level? And then obviously China, given that the lockdowns continue to persist and are continuing to create some long-term issues. And by long-term, I mean, over the next really several quarters. If you think about, we never really caught up to the first lockdown, given how it progressed through the system. And what is that going to mean going forward? So with that being said, we're not going to cover too much on Russia, Ukraine, just because there hasn't been too many shifts. There's, as we said 2 weeks ago, that Russia had made a push into the eastern Ukraine, pushing east to west. And since that point, there's been a big pause, and the Ukrainians have been able to have and launch some successful counterattacks, knocking them back, retaking some key areas, and we're actually starting to see some other types of outcroppings. If you think about where Russia the holdings really are all the way over, now we're starting to see some cities and some areas that were initially considered under Russian control, where you're starting to see some counterattacks and some movements there, which again just shows that there's a lot of a fight within the Ukrainians. They're fighting for something, and where the Russian soldiers, why most of them are sitting there why are we here? What is actually happening? And you're starting to see that to take effect. And then we did have Ukraine hit and strike some areas within Russian territory. So again, you're starting to see that push, but the reason why we talk about that right now is because the back and forth is always, well, where is Russian product going to flow? Europe's been talking about trying to phase it out, and I should say the EU, and there's been several pushbacks, one from Hungary, now from Greece, and they're trying to make do where it's okay, well, you have until 2023 to phase out. You have until 2024 to phase out, where the G7 has come together and said that they will phase out crude purchasing and energy purchases from Russia, but Russia still needs to sell it somewhere. And where is it being sold? So when we look at where a lot of this is flowing, you can see pipelines to China and how there is some spare capacity. Now, as we said before, China and India continue to be a large buyers. We talked about it in the EIA show. But when you look at pipeline flows, they're continuing to go up, and there is some spare capacity. So even though pipeline flows have increased since 2013 and have accelerated again with new pipelines coming on through 18 and parts of 19, you can see that the usage is there's still some spare capacity. And the ESPO pipeline does have some spare capacity. And if you think about ESPO, that has been one of the big things that China has been buying. And that has resulted in more crude being left in the water, especially in the West African front. And we do expect China to take down some of this additional capacity, especially as inflation is ramping up within that country, as we will discuss in segment 5. So then when you think about wheat and the movements, top 10 wheat exporters by weight, Russia is obviously 20%, Ukraine is 8%, and the share of countries' total wheat imports that come from Russia, Ukraine, you get an idea of just how much of a problem this is, because the wheat harvest continues to be lackluster in the States as well as in Europe, and that is leaving a lot of yield in the market that really can't be made up. And that's where then you take that on the yield side, then you kind of essentially cap where Russian wheat and Ukrainian wheat can actually go to. And that's where you start to see how this is a cascading effect. And because of those yields, unable to essentially make up what's there, there's been rumors back and forth from India, which is about 3% of the global market. They're going to ban exports. They're not going to ban exports. But regardless, there is a huge drought issue within two of the largest wheat producing regions of India that is cutting total yield. And as we talked about in our insights and I believe it was on Twitter, we talked about how the yields are failing, especially in Texas on the wheat front, which is going to create more issues. But now, while all of this is happening, this is an updated chart on real wages are continuing to fall. And it's not just in the US, it's a global issue. And when you look at the annual percent change, you can see that Japan is now negative. The US, Canada, UK, and Euro area are all down anywhere between essentially 2% or greater in terms of the actual, the discretionary capital available, because wages are falling, but they're still elevated. But then when you bake in inflation, you get an idea that disposable income continues to weaken, and that's going to, and already has started to show up in retail sales, in consumption, which is going to put more pressure on not only the EU, but also the US. And it's happening at the same time that emerging market external leverage is going up. And the reason why that's such a problem is because you have the dollar that is continued to rally and strengthen. The DXY is over 104, which is just a measure of the US dollar. You have bonds that need to be rolled. And at the same time, you have to issue new debt because some of these countries continue to run deficits. And with that being the case, inflation continues to be a big problem, which again, these countries have to then go out and purchase dollars or purchase treasuries or purchase something to help stabilize their currency, because in order to stabilize the currency, you buy your local and you sell your foreign reserves. And that's how you try to manage some of this inflationary fears. But then it becomes self-propagating, because if you're selling down your foreign reserves, then what is backing your currency, which is then why you have to go out and replenish your foreign reserves, which then creates this strengthening factor, especially when you look at the dollar. So this is going to be something to watch, where the pain is only just starting, and we really think it's going to get much worse. And by that, we mean that subsidies will get cut. You'll see a reduction in spending, and that's going to put more pressure on some of these EM countries. All the while, China still holds more than 1.5 trillion in U.S. securities. This is unlikely to change as they continue to rely on the U.S. dollar and treasuries to backstop their local currency and to try to mitigate some of these inflationary fears, especially when you think about how China continues to try to reissue debt, roll debt, get you new debt. This is going to be something to help backstop and provide some of that cover. But then when you look at the central bank monetary policy, you can see how the implied changes continue. Everybody is in a rate rising cycle on the G10. And these are all of those key banks that are really setting the pace for monetary policy and where rates are going to go, which is why we've continued to see rates go up. We've continued to see this pressure. And as rates go higher, that's only going to make things worse when you look at emerging markets, because it means their cost of borrowing goes up. So then their interest expense goes up, again, creating more pressure going forward. And then when you look at China, because China is going to be the key one, especially when we consider getting away from Russian energy, here you can see that China dominates the processing of these key minerals. So if you want batteries, well, where's nickel, cobalt, graphite, lithium, manganese? Who's producing most of these batteries? On the cathode anode side, you're looking at over 80% of batteries are created in China. So if we're going away from Russia, who's generating a large part of the world's energy, about 11 plus million barrels a day, and we're going to go and we're going to replace that, well, we're going to replace it with some other form of energy, some other form of battery technology, and it's originating in China. So we're going from Russia to China. And again, do we really fix anything, or we just jump from the frying pan into the fire? And this is something that we think has to be addressed, especially when you think about the U.S. becoming more stable and independent. And then speaking of stable and independent, here's just showing some of the pressure when you look at the manufacturing supplier deliveries. Because remember, the supplier deliveries had gotten better. But if you look at when China had those first issues in 2020, the Z-score got to 11. Right now, the Z-score is at 8, and they haven't reopened yet. So if you think about how that interacted, how that became bigger problems, that's why we think that the supplier deliveries are going to get worse again after getting better. And that's going to provide some of that supply side inflation that we've talked about. And that last push, which we're really going to see kicking off in earnest, really from now as we progress through June. And then realistically, when they reopen, you have to kind of strike about almost 8 weeks from that point based on sailing time before we start to see even a semblance of some sort of normalcy coming to our coast. All the while, weaker export orders because people are trying to pivot away from China. How do we replace China? Is it through Vietnam, South Korea, Japan? How do we try to get this stuff so we're not so beholden, so our delivery times get worse, but not seizing up because people were caught so flat-footed the first time? So when you look at the biggest export economies, especially Germany and China, they're seeing their new orders in the manufacturing PMI fall sharply, which is just showing again that global demand is falling. And then when you look at foreigners in the U.S., because you would think that people would be wanting to buy U.S. Products, but you're seeing that U.S. bonds, but no one's looking to buy corporate bonds, and that's, I think, a bigger issue at this point because where are rates going? Rates are going up. Well, I want to be compensated for the fact that rates are going up. But so far, we've seen this hesitancy in terms of seeing these rates go up. So again, they're selling corporates, buying treasuries, or just trying to bring cash home and trying to stabilize. So this is going to be a problem, especially when you look at rates between high yield and investment grade in the U.S. in terms of where are rates going and how are they going to be issuing new debt at this point in time. And that's why the credit impulse versus global sentiment is moving in the wrong direction, because credit impulses are falling because people are just scared to borrow. People are not looking for, when you look at especially China, there's credit available, just nobody wants it because you're looking at your balance sheet, you're looking at your leverage, and you're saying, I can't take on more. I can't leverage this balance sheet further, so I'm going to have to cut back. I'm going to have to try to tighten my belt to avoid a lot of these underlying pressure points. So then when we look at the global monetary stimulus, this is why stimulus continues to move back down. And as stimulus moves down, it's going to inherently pull that PMI lower, which is what we're seeing with a lot of those leading indicators in terms of new export orders, new orders in general. And you're starting to see that pressure, especially as rates going up. People want to limit the amount of new borrowing. And part of the reason is when we start looking at road freight in China. So here you can see where road freights are. Shanghai is at some of the lowest it's been. Nationwide, you've seen a little bit of a bounce because remember, there was a shift to lift some of the bans, to open up some of the roadside fueling stations, to get rid of some of these checkpoints to try to streamline. But it's still a problem. And if you look at this in comparison to the original lockdown, you see a lot of these slowdowns are going to continue as the vessels continue to pile up, with COVID lockdowns worsening on the global supply chain level, which is creating a lot of these issues in the different container ship fleet. And one of the shocking things is the ship fleet is estimated to be stuck in port congestion, and the number of ships awaiting berth at Shanghai are up 34% from last month, and 1/5 of the world's container ship fleet is estimated to be stuck there. I mean, the sheer numbers are shocking. So just to clear that in China, then to get it on the water, then to get it to the other side, you're getting an idea of just how this is going to create essentially a tidal wave, which is going to move the problems from one country to another, creating a lot of these shortfalls. And then just looking at it a bit differently on the 14-day moving average, you can see that we continue to press higher and moving further and further away in terms of the waiting time, which is almost 3 full days. Now, China factories, they did have some excess inventory, so you haven't seen too much of a slowdown on the manufacturing side. It started to come off a bit, and as you see a whittling down of inventories, that slowdown will accelerate. But you're getting an idea that still they're in a comfortable spot in terms of filling the orders that are currently on their books. It's also easier to do it when those new orders are slowing. But then as those new orders are slowing, it's because even if you can make it at the factory, it doesn't mean you can get it in the water. And that's what we're seeing here, where the industrial ports index continues to get worse and is actually worse than it was during the original lockdowns in 2020, which again is pointing to just how problematic this is going to be on the other side. Then when we start looking at the retail sales continue to weaken, retail sales growth weak this year. The driving force, obviously, in China's economy is meant to be investment, especially in infrastructure. However, the satellite data shows that the much anticipated investment stimulus didn't materialize in March, despite official data showing 12.5% increase in fixed asset investment in infrastructure. So again, retail demand is falling. A lot of these investments are not coming to fruition, and this is why we remain concerned, or at least cautious, on what Chinese growth is going to look like, because a lot of these global estimates are based on China seeing a big increase. Which is why when you start looking at where we are today, obviously factoring in China and then also taking out China, you could see that the global manufacturing PMI output is in contraction. And some of this is driven by China. Some of it, if you take China out, it's just in expansionary territory. But again, we're moving in the wrong direction, which is the bigger problem that we're seeing for global growth and that expansion overall, which is when you start looking at product shortages are starting to reverse again. You look at Japan going back up. The UK is starting to flatline going back up. And the US is reverting again, which is only going to get worse, as China remains in a steep lockdown, which is then when you start looking at the China adds to the risk, especially when you look at Europe, where Europe follows it considerably when you look at the Euro area and GDP growth, that the economic expectations continue to come down because of China, because of that delay, which is where we continue to see that contraction and the negative growth. And we do think that Europe is already in a recession. And the US here, you can see something similar when you look at ISM manufacturing and new orders minus inventories moving in the wrong direction, showing that leading indicator slowdown, which is going to be, again, lead us more into a recessionary backdrop in Q3, especially when you have the issues, if you will, with Chinese goods making it to our market. But all at the same time, you have financial conditions tightening, which is you have all of these slowdowns coming through. You have all these problems while financial conditions are getting tighter, which means that we did have that available credit, but that available credit is starting to dissipate, is starting to slow down. So you already had demand slowing. Now you have the availability slowing. It just started. So it's not like it's a huge problem, but you're starting to see some hesitancy, and it's really because what rate are we issuing at, which is why we continue to believe that the IMF growth forecasts need to be cut further. You get an idea of just where they've cut things so far. And this is April 2022 versus January. And you can see that they continue to get worse. And we think that there's a prolonged piece. And the reason why we say that is because we're in May. This was struck in April, and you still didn't have the same type of lockdowns or the length of time of these lockdowns in China. So the longer this goes on, the bigger the issues happen, the more likely a Russian ban happens, the higher the costs are going to get, and the more problems that we're going to get in both the Eurozone. And again, with the strength in the dollar and US rates, you're going to get more and more pressure on the emerging market front, which is when you start looking at containers bound for the US from around the world is about to experience a serious volume drop. By June, US port volumes may match May 2020, the early days of the COVID quarantine. So again, those supply side, those inventory levels are going to continue to drop. Container volumes out of China to the U.S. have dropped 18% since April 6th, but are set to drop another 37% between now and May 12th. to get an idea of the continuous problems and availability of product in the U.S. All the while, when we start looking at U.S. agriculture-related exports to China, we're setting a new record. U.S. exported a record $9.8 billion worth of ag products to China in Q1 of 2022, up 19% on the year. Soybeans, corn, cotton, and sorghum accounted for 72%. Q1 soy and corn exports to China by value were up 19% from 2021, but volume was up only 3%. Again, just giving an idea of that inflation that's being passed on. And it showed up, and we'll talk about that in segment 5 of the show. Now, some big movers in Q1 versus Q1 of last year were beef exports to China up 113% by value, 78% by volume. Poultry was up big as well. Pork fell 48% by value and 56% by volume. Wheat and ethanol, prominent in Q1, completely fell off the list. So you're getting an idea of some of the shifts, how China's trying to manage it, and how things are going. And again, wheat is just not available or priced itself out of the market. And even with that, you're still seeing a huge export to that market. And then when you look at the cost of planting, World Fertilizer Price Index continues to be elevated. And depending on where you are, it's at an all-time high or at least near record highs, even if it's fallen back, because of the availability issue and the problems in general. Fertilizer prices are up on average of 70% from last year. The fertilizer is available locally, but it's out of reach for the majority of farmers. Worse, many farmers know that they cannot recover these costs, which again is limiting the amount they want to put down, the amount that's available. And here you can see with the U.S. side just how expensive it is and where it is versus historics going back to 2016. You can see the underlying problems. And then if we pull out a bit and we look at food pricing going back to the early 1990s, you get an idea of just how elevated food prices are on a global scale. It's pulled back just a touch, but it's hard to continue to maintain this kind of pace. But then when you start looking at, again, newer yield problems, newer problems in the food side, we've had crop price, future prices go back up. And again, we're setting the stage for another push higher, because if you look at in 07, 08, that was that first spike. You had a lot of inflation. You had a huge shortage of dry bulk that then diminished. You had that big drop. And then you had some poor yields as we went into 2010, 2011. And you can see that as the yields recovered, you still had a lot of costs, which is why that slowdown, that normalization didn't really happen until you got to the end of 2014, and then you started to see some of that drop off. And it was obviously helped by crude prices coming down in the back half of 2014 and then through 2015. But here we are on the backside of that. But it's more than just crude. You have yield shortages. You have inventories at near record lows. You have yields at near record lows, which again are creating some of these problems, or at least in multi-decade lows. And here's just an example of farmers in Mato Grosso. Brazil have sold 58% of their 21-22 corn crop, below 74% last year and 64.5% on average. The state agency, IMEA, says it's because farmers are waiting for potentially higher prices, and the recent dryness has also caused production uncertainty. So the last thing they want to do is, well, obviously they want higher prices, but if we offer to sell this, can we actually meet that offer? And that's where you're starting to get some of the hesitancy. So we could get some of that pickup, but again, we're not going to get this huge adjustment. And here's where an example of that with monthly Brazil soy exports really dropping off after starting strong. And it's not so much because they don't want to sell it, but it's the availability of the product. Do they have the product available to sell? And the answer is no, because you have those big issues on yield. You have the issues on drought. And remember, there's multiple ways to move soybeans in Brazil, by road, by rail, but also by river. So as you get this dryness, you can't put as much stuff on those boats, because as the river level drops, that means you have to cut weight to keep it afloat and keep it from hitting ground, which again also limits how quickly this can move to market. So even if you have the yield, is it going to be rotten by the time it gets there, because the timing is just going to take so much longer? All the while in the U.S., we had another explosion. We had two corn silos explode. in Illinois, which again, we have aged infrastructure, we have young people or newbies that are trying to manage this, and it's creating a significant or increasing the amount of accidents that we have. So now in the next segment, we're going to go deeper into the U.S. GDP, and where do we see things setting up for Q2 and Q3 of this year.